How's it going, everyone? We got a great one here for you today. We're going to be talking about what, in my opinion, are the best monthly dividend stocks. We're going to have a couple ETFs in here as well. So we'll just get cracking right into it. Obviously, there are probably several companies that do pay monthly dividends, and there's a lot of reasons for that. So the benefit of monthly dividends, obviously, being the fact that if you're taking your dividends as a source of income, or if you just simply want to compound them, the more frequent you get paid out with dividends, the better for you in that aspect. So take that into consideration. So that's why a lot of people are hunting after these monthly dividend strategies. And I got a good few companies here for you today, and a couple ETFs that you can follow if you're interested in getting into that monthly dividend game. Okay, so let's go ahead and start with, I think we all know what we're starting with, and it's going to be Realty Income, ticker symbol O. This is a company known as the monthly dividend company, right? So this is the cream of the crop when it comes to that. And if you aren't aware, obviously, this is a stock that's actually done well in terms of capital appreciation too. So last year showing a 13% gain. In the last 5 years, actually up 12.5 is actually relatively high for the real estate investment trust industry that it's in. You'll notice that with a lot of these high yielding monthly stocks, you're going to see a majority of them are going to be real estate investment trusts or business development companies. So keep that into consideration as they are required for tax purposes to pay out upwards of 80% of their net income. So take that into consideration here. But this is a stock that's also had decent performance historically in terms of stock price. So that is something you got to consider as well. Not only is it a great dividend play, but there's also capital appreciation potential here. And if you're not aware of Realty Income, so obviously right on their homepage, they'll tell you a little bit about what they're about. So compound average annual return since 1994 listing, 15.3%. That's quite incredible when you talk about compounding average there. So again, if you've been investing since 1994, you're making 15% a year. That's quite significant. They've paid 613 consecutive monthly dividends, 95 consecutive quarterly increases because they increase every quarter. Lately, it's typically being done by a fifth of a cent. So keep that in consideration. And annualized dividend growth rate compounding since 1994 is 4.4%. Pretty significant annually in my consideration. I like it. As far as their portfolio, it's worth mentioning. 6,700 properties, one that continues to grow actually. 630 different clients, which is fantastic. And 58 retail and other industries. So you need to consider about that because this is a diversified company in terms of the portfolio that they have under them. So some of the highlights here we'll mention. They've gone through a little bit of a shift since 2020, which was a smart decision. So prior to 2020, they had a lot more companies here in the top that were a little bit more devastated by last year and ability of people to go out. So you saw a higher presence of LA Fitness the year prior and a lot of these fitness companies, and since they've kind of switched it up a little bit. So now you see highest being 7-Eleven never shuts down, Walgreens never shuts down, Dollar General, FedEx, Sainsbury's, that's right, I said it like I should have, Dollar Tree and Family Dollar. So again, this is a very well diversified, you can see it all the way through. Your Home Depot, Kroger, Walmart, Sam's Club. They even have movie theaters. It's a very well diversified company in terms of the clients that they have in portfolio. So very nice to see that, all things considered. If you look at portfolio occupancy, obviously something they've always been able to tout is the fact that they've had very consistent occupancy in terms of portfolios. So, and then again, this is residents, or this is properties that are actually occupied that they own. So pretty significant. And you see the difference here in total properties. This is nice. We saw a little bit of a jump in 2020 in terms of vacant properties, obviously, as you can predict, as people weren't able to pay because their businesses were shut down. That is why. But what I really like is this total properties thing, because this is a company that's continuing to grow their portfolio. And you see that in the revenue line too. If you look historically in the revenue line, that is a very healthy looking revenue line there. I mean consistent growth here. Obviously it's slowed down since a big jump here in 2013, but it's still a consistent green all over the place. The only exception being the financial crisis, obviously. Didn't cause that much of a dip for them, but it's very, very slight. But again, this is a consistent growth, and I like it a lot. If you look at dividend history, just so you're aware, 24 years of consecutive growth on this company, 5-year growth rate of 5.63%, yielding 3.9% right now. And again, you can see that if you look historically, this is one of the most enjoyable charts to look at if you look at dividend history on this company. Because of the fact that it's consistent growth. Now, unless Seeking Alpha wants to be rude, which it does. So, there we go. Look at that. It's satisfying because you see, look at that. Just slight ticks of growth every single time. Every single time. We love to see it. It's growth like no one's business. Look at the amount down here. Growth, growth, growth. It just keeps growing. So, that's why we like it. Consistent growth, 24 years. They're not going to stop it. They've been growing it since they listed it. So this is a company that's going to continue to grow the dividend. Next will be Gladstone Corporation. One that I've had for a decent while, actually, in my personal portfolio. And I like it quite a bit, actually. And if you look at performance in the stock itself, it's worth mentioning. This is one that's actually seen some pretty significant performance as of late. 58% growth in the last year. And even on a 5-year standpoint, a 37% growth is quite significant because a lot of these companies that are in the same boat as this have actually kind of failed to recover their pre-2020 levels. And this is a stock that's actually gone up since then. So significant process there, or progress. And if you look at, obviously, Gladstone, what they do, they provide loans to lower middle market businesses. So again, this is more of a business development company type where they make their revenue off of loans. So just a couple of people they own, obviously, or people they loan out to. You might not know some of these, obviously, because they're lower middle market, so they're not quite as massive. But again, it's a very diversified sector here. We have aerospace, defense, telecom, home and office furnishing, restaurant, education, automotive, chemicals, dredging and marine services. I thought that's what you do whenever you're battering a chicken, is dredging it, but that's fine. That's just me. Food, oil and gas, building and look, it's an incredibly diversified portfolio that they have here, and it's one that's certainly in the process of growing. And you see the revenue chart here, obviously, was great, and the financial crisis did a number on them, and they recovered quite significantly from that. And last year did a slight number on them, a slight divot here. But since they've recovered and are higher than ever now, as of the most recent quarter. So again, I like where the revenue's headed on this company, and it's a growing portfolio. They're doing great things. Their assets are actually very well managed. So quite significant. I like what they're able to do. If you look at dividend history, one thing as well, again, you'll notice no dividend growth, and actually declined over the last 5 years in dividend growth rate. But a 6.7% yield is quite significant. And if you look at the history of this dividend, which is one that I still find quite satisfying, they typically will pay consistently the same amount every single month, right? 7 cents. And since they saw a little dip last year, which is not significant to me in my perspective, I'm perfectly fine with that. There was a little dip last year, but they've since actually boosted it since then. Not quite back to the 7 cent full level. But again, in its heyday prior to the financial crisis, you look down here, this company was paying 14 cents a share. We'll see what that looks like as we go into the future, but I do think they're going to try to keep it consistent, at least for the near future, at this 7 cent line, that they should be able to boost up. My assumption is by mid-2022. So still a very good yield already on this company, and with some good capital appreciation that this one's been able to pull off. So I really do like Gladstone at these levels. So next you have Main Street Capital. This is a business development company. Main Street has a lot of great things going for it. So we'll look real quick at the stock, how it's been performing. 39% growth in the last year on this company, mostly because of recovery from 2020, as you can see. So they were hit quite hard due to this, as most of these companies were. We're talking about a dip of 60+%. But it has recovered to, pre-2020 levels, relatively flat with where it ended 2019 on, actually. So good performance here in the last 5 years, showing a 21.8% growth is actually pretty good for a lot of these business development companies. So let's talk about Main Street Capital, based in Houston, Texas. Has helped over 200 private companies grow and transition by providing flexible private equity and debt capital solutions. Again, they are a business development company. They will loan out money to companies that are developing. And you look at, obviously, some of the companies within it might not be ones you necessarily know. Nothing crazy, because, again, these are developing companies that they're loaning out to. And they do great research in terms of the companies they're going to give their money out to. And I think that shows on what they're able to do with their revenue line here, right? We see a consistent number. This is since 2007. Consistent growth. The only dip, which they handled the financial crisis very well, by the way. I will say, again, this is a company that was still in its infancy at that time. Very small. We're talking about $10 million of revenue only. Nothing crazy, but they handled that well. They survived that. In 2020, they were barely phased, all things considered. They saw a slight dip, and now since then, they have recovered to the pre-2020 levels where they ended 2019 at. So the company recovered very quickly from that. Only 3 quarters here of a dip doesn't shock me at all. I mean, the companies they were specifically loaning out to are ones that were pretty heavily affected, all things considered. And they've been able to really, just due to the fact that they invest in good quality companies, they've been able to succeed in that aspect. So you look at the dividend history on this one. Again, no dividend growth on this one on the last, consecutive at least. That was thanks to last year, by the way, but 5-year growth rate of 2.64%. And a 6% yield is pretty significant. You look at the history, and you see some good stuff here, right? Obviously, they have some announcements of special dividends here that they've had in the past. Not something you've seen for quite a while, obviously, because of 2020. And maybe they'll do that. Who knows? Who knows if that special dividend amount will come, but that's kind of what's impacting their dividend growth, because that's really counting towards it, right? So if you forget about the special monthly dividends, right, the unknowns here, they're actually consistently growing this dividend from 20.5 cents to 21 cents actually now as of late. So very nice stuff. And they obviously declare monthly every single quarter. They'll declare for the entire quarter. So very nice to see that. So there actually is dividend growth here, as much as you don't want to admit it's seeking alpha. It has been consistently growing for a long time now. And 2020 wasn't even able to stop them. So the only reason why it doesn't show dividend growth is entirely because of here you see these unknown other dividends here that are just extra special dividends. So impacts it on seeking alpha, but all things considered, they're growing this dividend monthly. It's beautiful, and they're at no risk of really cutting that dividend, all things considered, based off of what they're able to do. So I like it quite a bit. My last of specific companies is going to be Prospect Capital. Prospect Capital I like for a lot of reasons. I think this is one that's been very undervalued historically, and I think this year's kind of presented that. 58% up in the last year. And you look in the last 5 years, it's actually still down a little bit. 2020 was certainly showed a dip, not quite as bad as a lot of the other companies, right? Only around 42% that dipped. But since then has recovered quite significantly, actually, upwards of 100%. So very significant recovery from that point. But I still like this company quite a bit at these levels, and there's a few reasons why. So you look at Prospect Capital, again, this is also a business development company that make debt and equity investments in the U.S. middle market business across a range of industries. And again, $6.3 billion in assets and 365 investments funded. If you look at the portfolio on this, it'll be a similar story. We don't necessarily know these companies. You might not. but it's very well diversified. Food products, consumer finance, insurance, healthcare, textiles, household products, commercial solutions, entertainment, Cinedigm, baby, financial services, energy equipment, aerospace, paper and forest products. Again, it's a very well diversified company that invested a lot of quality companies. So good, all things considered, in terms of that. And the revenue chart could be better on this one. I won't lie to you. It's actually been very flat historically since 2015. We've seen actually a dip. But since then is not really changed all that much. We see some green, we see some red. Obviously last year there was some red, and now we're seeing some recovery as a result of that. So in my opinion, I think based off this company's current strategy, we'll see that revenue be pretty flat on a long-term basis, in my opinion. So I think this is a company that's going to be trading flat for in terms of revenue for quite a while. Now, what does that do with the stock price? I don't know. It's a relatively undervalued stock, all things considered. Book value on this one right now is actually over $8. So technically, this stock is undervalued according to book value from their last earnings. What I like a lot here is going to be the dividend here. 0 years of dividend growth rate, not that bad, but a 9% yield on this company. This is a beautiful one because it pays 6 cents every single month for me. I like it a lot. We saw the dip here from 2017 where it was paying 8 cents, but since then, 6 cents consistently. I don't see a dividend cut really happening. They've paid 16 years of consecutive dividend payments. I don't see a cut beyond the 6 cent mark. It's very manageable for them in terms of what they're bringing in NAV, but again, they cut it in 2014, and then again here in 2017, but I really don't see them cutting it again in the near future. I see that this is going to be a consistent 6 cent earner for quite a while. It's a pretty darn good yield at a 9% yield in my opinion. So, and I think there's room for capital appreciation. If not, the stock will trade stagnant. I don't really think it's going down anytime soon based off of book value. So let's get into a couple ETFs that I like. First one's going to be SPHD. SPHD I like because of the consistency here, right? If you look at the performance of last year, up 31.11%, and only 16% growth in the last 5 years. That's because of a huge dip in 2020. Again, you see this thing fell, massively, 30+%, and since has recovered 63%. I like this one because it's a consistent, low volatility, and a high dividend payer. Because again, when I say low volatility, again, we saw a dip of this company, or this ETF, only around 37%, while the entire market dropped 45+. So again, it's low volatility, which means returns a little bit lesser, but the dividend's pretty nice on it. If you look at some of the companies they own, it's quality companies. So this is just a general idea here. Pretty diversified, 20% in utilities. We've got PPL, Edison, if you know them, Dominion Energy, Duke Energy. Consumer staples, they've got Altria, Philip Morris, Walgreens, Kraft Heinz, Kellogg. I mean, these are very consistent companies that don't move that much. Healthcare, we have Pfizer, Gilead, AbbVie, great companies, Merck. Real estate, Iron Mountain, which obviously I love quite a bit if you know me. Realty Income in there, because why not? Information technology, HPE. They've got some good stuff. Consumer staples, AT&T, which I actually think they're going to change their stake in AT&T in the near future due to a dividend cut once that happens. So keep that in consideration. Energy, materials. So it's a very well diversified portfolio, and that's what leads to a very low volatility on this company. If you look historically in terms of dividend, 4.75% growth rate, 3.69% yield is pretty nice, all things considered. And I like this one more as a consistent play. That's what I really like it for. If you look at dividend history, again, you saw a special one here in 2016. I'm assuming that's because one of the companies paid a special dividend, but obviously it's all around the board because this is reliant on the companies and what they're producing, but it's very consistent here. Monthly dividends, I like it quite a bit. I'm a big fan of SPHD. It's one I've held for quite a while. It's just consistent and really not that volatile. So There are obviously some other ones out there that pay monthly that are a little bit more volatile, that do provide more capital return, but this is more of a safe play if you're interested in that. More aggressive play here being J.P. Morgan Equity Premium Income Fund, JEPI, if you're not aware of this one. So this one is a exchange traded fund that is focused on covered calls. So due to it being a covered call strategy, there's a much higher potential for income. But with that becomes a much higher potential of volatility. So basically, if you've ever partaken in covered calls yourself or any form of options, you know there's a lot more volatility in that aspect. But with volatility also comes the potential of more reward. Now, historically, this stock is, it's performed pretty well in the last year of 18.39%. And really, this was started here, listed in May of 2020. Since then, it's shown a 24% growth. Is actually very, very nice, all things considered. So, in a year standpoint, I like seeing that kind of growth. But this isn't one that's necessarily focused on capital appreciation, but it provides the opportunity for it as well. And if you look, again, this is designed to provide current income while maintaining capital appreciation prospects. It's an actively managed fund, obviously. And people that are doing this, we have Hamilton Rainier, who has been 34 years in the industry and 12 years with J.P. Morgan, and Rafael Zingone, who has been doing 30 years in the industry, and all 30 have been with J.P. Morgan. So, again, these are actually decent portfolio managers who have been in the industry quite a while, and they know what they're doing. So, all things considered, it's pretty nice. You see a 30-day yield on this one of 6.55%, shows a lot of return potentially in terms of dividend there. Expenses are not that high, actually. 0.35% is not that incredibly high for a actively traded, actively managed fund. All things considered, it's not bad at all. And if you look at the portfolio, you're going to see these calls here, obviously. You can download all holdings, but these are covered calls, which obviously amount to where they pay out their dividends from. Their dividend payments are entirely reliant on the income they receive for that month. So we see, and some of their holdings, they've got quality companies here too. Intuit, Microsoft, DT Energy, and Google. They've got quality companies here as well. But again, it's based off of their income, what they pay in dividends. But you look historically, it's a nice dividend payer, all things considered. We've seen a slight dip in income as of the last little bit. The last couple months, you've seen it's a little bit slower actually in performance wise. But I do think next quarter, I'm pretty positive based off historical performance, probably looking around 37 to 38 cents. With some change, obviously, on top of that. But it's a fund I really like, and it provides a lot of income. And the thing about that is, you got to consider what happens with this income, right? This is why I've always mentioned getting in the market now is better than never. I mean, good grief. So if I were to bring up a compound calculator here, you can kind of see where I'm coming from in that aspect. So let's say right now you were to invest $10,000 into, and let's say every month let's say you're pretty conservative, you're only adding $100 a month into it over a 30-year period, and we're going to be earning, in terms of JEPI, let's say 6.5%. And with that, we'll say it varies around 2%, so it could be higher, could be lower. And this one's going to compound monthly, obviously, in that aspect. Let's go annually, just so you have an idea. Let's not get too crazy. And you see what that $10,000 investment turns into in just this one holding can turn to $169,000 over that period of 30 years. And again, it could be upwards of $264,000 if it were to be an 8.5% yield the entire time, and downwards of $110,000. But over a 30-year period, we're talking about significant growth rate. and that is 100% without capital appreciation. So you got to consider the more you have invested sooner, the better that can be. Because again, let's say that instead you put 50,000 in, right? 50,000 in initially, and even if you didn't make any monthly contributions, you can see what that amounts to: 330,000 and upwards of 577,000. And let's say you have a good paying job and you're able to contribute 500 a month, just to put that into consideration. And that investment is worth $848,000 in 30 years. So let's say you're 20 years old and you, if you happen to have that money, but if you don't, it's fine. But this one investment here, by the time you're age 50, will be worth $1 million, and you only put in 50,000. So just take that into consideration in what you're able to do there. So that's what I like it a lot. I like it a lot. And let's just say if it compounded monthly, oh yeah, baby. Oh baby. Now we're talking. But that's what I got for you today. That's why you got to get invested in the market. Monthly income, pretty nice for you. Hope you had a good day, and have a great one.